Imagine, if you will, a cool evening in the year 150 CE. The sun has long since dipped below the horizon, casting the ancient city of Samarkand into a gentle twilight. In a modest caravanserai, a way station for travelers along what we now call the Silk Road, a Chinese merchant sits cross-legged on a woven mat. Before him lies a small wooden chest, worn smooth by years of handling. Inside this chest are dozens of different objects, bronze coins with square holes in their centers, silver bars stamped with official seals, leather pouches containing tiny glass beads, and even a few carefully folded silk scarves. This is not merely the merchant's wealth, it is his toolbox for survival along the ancient trade routes, where the simple question of how to pay for things becomes unexpectedly complex. Tonight, we embark on a gentle journey through time, exploring the fascinating and surprisingly intricate world of money along the Silk Road. We will move slowly, methodically, through the various systems of payment that allowed merchants to conduct business across thousands of miles, through dozens of different kingdoms and territories, each with their own ideas about what constituted valuable currency. This is not a story of dramatic discoveries or sudden innovations. Rather, it is the quiet, steady tale of practical people solving everyday problems. The kind of story that unfolds at a pace conducive to rest, to contemplation, and perhaps to sleep. Before we can understand how merchants paid each other along the Silk Road, we must first understand what the Silk Road actually was. The name itself is something of a modern invention, coined by a German geographer in the 19th century. The ancient travelers who walked these paths never called them by any single name. To them, these were simply the roads, the routes, the ways between one place and another. The Silk Road was not a single road at all. It was a vast network of interconnected trade routes that stretched from the ancient Chinese capital of Chang'an, in what is now Xi'an, all the way westward through Central Asia, through Persia, and eventually to the great cities of the Roman Empire. Along the way, these routes branched and forked like the limbs of an ancient tree. Some paths led north into the steppes. Others turned south toward India. Still others wound through mountain passes so high that merchants sometimes struggled to breathe the thin air. The distances involved were staggering by ancient standards. A merchant traveling from Chang'an to Rome would cover more than 4,000 miles. This journey could take years to complete. Few merchants ever traveled the entire length of the route. Instead, goods passed through many hands. A bolt of silk might begin its journey in a Chinese workshop, be sold to a trader in Dunhuang, then purchased by a Sogdian merchant in Samarkand, then acquired by a Persian trader in Ctesiphon, and finally, months or even years later, end up draped over the shoulders of a Roman senator. Each of these transactions required payment of some kind. And here is where our story truly begins. For in the ancient world, there was no universal currency. The Han dynasty had its own system of money. The Parthian Empire used different coins entirely. The Kushan Empire had its own ideas about currency. The Romans minted their gold aureus and silver denarius. Even within these great empires, regional variations existed. A coin that was accepted without question in one city might be viewed with suspicion in another. So how did merchants manage? How did a Chinese trader with pockets full of bronze cash coins purchase supplies in a Persian market? How did value get translated across cultural and linguistic boundaries? The answers to these questions are more varied and more interesting than you might expect. Let us begin with the most basic form of payment, one so ancient that it predates the invention of coins themselves. We speak, of course, of barter, the direct exchange of goods for goods. When most people today think of barter, they imagine a simple primitive system. You have grain, I have wool. We make a trade. But barter along the Silk Road was rarely so straightforward. The merchants who traversed these routes were sophisticated business people. They understood complex concepts of value, scarcity, and demand. They knew that the value of goods changed dramatically depending on location. Consider silk, the namesake commodity of these routes. In China, where silk was produced, it was valuable, but not impossibly rare. A bolt of fine silk might cost a few strings of bronze coins. But as that silk traveled westward, passing through region after region where silk could not be produced, its value multiplied. By the time it reached Rome, that same bolt of silk might be worth its weight in gold, literally. Roman writers complained bitterly about the high cost of silk, which they called the gossamer threads from the land of Ceres. This dramatic increase in value created opportunities for traders. A merchant setting out from the eastern end of the Silk Road might load his camels with silk, jade, and porcelain. These items were valuable, but not extraordinary in China. However, each mile westward increased their worth. The merchant knew that he could trade these goods for local products at each stop along his journey, always ensuring that the new goods he acquired would be even more valuable at his next destination. Barter required deep knowledge. A successful merchant needed to understand what goods were scarce in each region. He needed to know seasonal patterns of supply and demand. He needed relationships with local traders who could advise him on current prices. Most importantly, he needed patience. Barter transactions took time. There was haggling, of course, but also the practical matter of assessing the quality of goods, arranging for their transport, and ensuring that both parties were genuinely satisfied with the exchange. In the oasis city of Turpan, on the northern edge of the Taklamakan Desert, merchants would often spend days negotiating a single major transaction. They would meet in the marketplace in the morning, examine goods, make offers, counteroffer, break for meals, consult with their associates, and gradually move toward an agreement. There was no rush in such business. Trust took time to establish. And in a world where merchants might never see each other again, trust was valuable. But barter had its limitations. The most obvious problem was what economists today call the double coincidence of wants. I must have what you want, and you must have what I want for a barter transaction to work. This becomes increasingly difficult as the variety of goods increases. A merchant might arrive in a city with loads of Chinese ceramics, only to discover that the local markets were already glutted with ceramics from a previous caravan. Now what? The merchant needs supplies to continue his journey, but no one wants what he has to offer. This is where more sophisticated forms of payment entered the picture. Money, in the form of standardized coins, was one of humanity's great inventions. It solved the problem of the double coincidence of wants. Instead of needing to find someone who wanted my ceramics and had the grain I needed, I could sell my ceramics for money, then use that money to buy grain from someone else entirely. But along the Silk Road, the existence of money created its own complications. For there were many different types of money, and not all were accepted everywhere. Let us start in China, for the eastern terminus of these trade routes. During the Han Dynasty and the subsequent periods of Chinese history that saw heavy Silk Road trade, the standard currency was a bronze coin, or qian. These coins were distinctive. They were round with a square hole in the center. This design was eminently practical. The hole allowed coins to be strung together on cords for easier carrying. A typical string might hold 100 or 1,000 coins. Chinese bronze coins were produced by official government mints. They bore inscriptions indicating the dynasty, and sometimes the specific reign period during which they were minted. The weight and composition of these coins varied somewhat over time, but they followed general standards that made them recognizable and within China, universally accepted. A Chinese merchant preparing for a journey westward faced an immediate problem. His bronze coins, while perfectly good money within China, would have limited value once he crossed into foreign territories. They were relatively heavy. Bronze is not a particularly precious metal, so carrying enough bronze coins to finance a long trading expedition would require significant load capacity. Moreover, foreign merchants would view these unfamiliar coins with suspicion. Why should a Persian trader accept payment in Chinese bronze? He cannot spend these coins in his home markets. Chinese merchants developed several strategies to deal with this problem. The first was to convert their bronze coins into more universally valued commodities before leaving China. Silk was an obvious choice. It was relatively light for its value. It was universally desired, and it could be converted back into local currency at any stop along the route. But silk had its own problems. It could be damaged by water. It could be stolen more easily than heavy bronze coins. And while it was valuable, it was not easily divisible. You cannot cut a bolt of silk in half to make change. This led to the use of precious metals, particularly gold and silver, as a more portable and universally accepted form of payment. Gold and silver had intrinsic value. They were prized in virtually every culture along the Silk Road. They were relatively rare, making them valuable in small quantities. And they could be measured by weight, allowing for precise transactions. However, gold and silver also presented challenges. Their value by weight was high, which made them targets for thieves. Merchants needed to be constantly vigilant. Moreover, the purity of gold and silver could vary. A lump of metal that appeared to be pure gold might actually be alloyed with copper or other less valuable metals. This led to the development of testing procedures. Merchants learned to assess the purity of metals by their weight, color, and sound when struck. Some merchants carried small touchstones, pieces of black basalt against which they could rub gold to check its purity. The really interesting development came when governments began minting standardized gold and silver coins. The Romans were particularly good at this. Their aureus, a gold coin, and their denarius, a silver coin, became widely recognized and accepted throughout the Mediterranean world and beyond. These coins bore the image of the emperor and various inscriptions guaranteeing their weight and purity. In theory, at least. In practice, Roman emperors sometimes debased their coinage, reducing the precious metal content to stretch the government's resources. Persian empires, particularly the Parthians and later the Sasanians, minted their own silver drachms. These coins featured elaborate designs, royal portraits, fire altars, religious symbols. They were works of art as much as instruments of commerce. and like Roman coins, they were widely accepted in international trade. The Kushan Empire, which controlled much of Central Asia and northern India during the height of Silk Road trade, produced gold dinars that showed influence from both Roman and Persian coinage traditions. The Kushan coins are fascinating because they feature images of gods from multiple religious traditions: Greek, Persian, Indian, and even occasionally Buddhist, reflecting the cosmopolitan nature of this trading empire. Now, imagine you were a merchant from Samarkand, a city that lay at the crossroads of multiple trade routes. You have traveled to China and acquired goods, silk of course, but also jade, lacquerware, and ceramics. You have sold these goods throughout Central Asia and accumulated a mixed collection of payments. You have Chinese bronze coins. You have some Roman silver denarii that another merchant paid you with. You have Persian drachms. You have some gold dust in a small leather pouch. You have been given a carved carnelian gemstone as partial payment for a particularly fine silk robe. And you have letters of credit from merchants in distant cities. This accumulation of different forms of value is entirely normal for a Silk Road merchant. Now, you wish to purchase a large quantity of supplies for your next journey. How do you pay? The answer involves money changers. Those often maligned but absolutely essential figures in ancient commerce. Money changers set up their tables in marketplaces and caravanserais throughout the Silk Road. Their job was to assess the value of various currencies and facilitate exchange. A typical money changer would sit behind a table covered with small bowls and cups, each containing samples of different coins. He would have a set of scales for weighing precious metals. He would have reference materials, perhaps tablets or parchments listing current exchange rates between different currencies. Most importantly, he would have a detailed knowledge of coins, their composition, and their relative values. The money-changing process was slow and meticulous. Let us watch a transaction unfold. Our Samarkand merchant approaches the money changer's table with his mixed collection of currency. He wants to exchange it all for the local currency of the city where he currently finds himself. The money changer begins by sorting the coins into groups. Chinese bronze goes in one pile, Roman silver in another, Persian silver in a third. Each type of coin may have subcategories depending on the dynasty or emperor who minted it, as these factors affect value. For the Chinese bronze, the money changer counts the coins and checks their weight. Bronze coins should meet certain standards, but worn coins might be lighter. The money changer has to account for this. He announces a number to the merchant. This many bronze coins will convert to this many local coins after his commission. The Roman and Persian silver coins require more careful examination. The money changer picks up each coin individually. He looks at it closely, checking the edges for clipping. A common form of fraud, where people would shave small amounts of silver from coin edges. He weighs samples of the coins on his scale. He may even perform a test, perhaps striking the coin against his table to hear its sound, which can indicate purity. Based on his assessment, he announces the value. The gold dust is weighed very carefully on a sensitive scale. Gold dust is among the most portable forms of wealth, but it is also among the easiest to adulterate. The money changer may perform a more elaborate purity test, perhaps using a touchstone and acids. The carnelian gemstone requires expert assessment. The money changer may call over a jeweler colleague to evaluate the stone's quality and size. Gemstones were indeed used as currency, particularly for very large transactions, but their value was highly subjective. As for the letters of credit, these represent a more complex financial instrument that we will discuss in depth shortly. The entire process might take an hour or more. Each step involves negotiation. The merchant argues that his coins are of better quality than the money changer acknowledges. The money changer points out wear and potential problems. They haggle over commission rates. Eventually, they reach an agreement. The merchant receives local currency minus the money changer's commission, which might range from 2 to 5% of the total value. This system worked, but it was far from perfect. Money changers could be dishonest. They might undervalue foreign coins. They might use inaccurate scales. The variability of exchange rates meant that the same coins might be worth very different amounts at different times or in different cities. Merchants had to stay informed about these fluctuations. Moreover, the physical process of carrying large amounts of coins remained problematic. A merchant conducting business worth thousands of coins faced security challenges. Large sums of money attracted thieves. Caravans had to hire armed guards. Even with guards, the risk of robbery was real. Many merchants lost their entire fortunes to bandits along remote stretches of the trade routes. These practical concerns led to the development of more sophisticated financial instruments. Letters of credit represent one of the most remarkable innovations in the history of money along the Silk Road. In essence, a letter of credit is a document promising that the holder can collect money at a distant location. It is a way of transporting value without transporting physical currency. The system worked like this. Suppose a merchant in Chang'an wishes to purchase goods in Samarkand. Instead of carrying thousands of bronze coins across dangerous territories, he visits an agent in Chang'an, perhaps a merchant guild, a temple, or a wealthy merchant house with branches in multiple cities. He deposits his bronze coins with this agent. In return, he receives a written document, sealed and signed, instructing an agent in Samarkand to pay the bearer a specified amount in local currency. The letter of credit might look something like this. It would be written on durable material, perhaps silk paper, parchment, or even a wooden tablet. It would contain several key pieces of information. First, the name of the bearer, the merchant authorized to collect the money. Second, the amount to be paid. Third, the location where payment could be collected. Fourth, various identifying marks and seals to prevent forgery. Some sophisticated letters of credit included secret codes or phrases that the bearer and the paying agent both knew, adding an extra layer of security. When the merchant arrived in Samarkand, he would present his letter of credit to the designated agent. This agent would verify the seals and codes. If everything checked out, the agent would pay the specified amount in local currency. The original agent in Chang'an and the paying agent in Samarkand would later settle accounts between themselves, perhaps when another merchant travelled in the opposite direction with a corresponding letter of credit, or through periodic audits and transfers of precious metals. This system offered enormous advantages. It reduced the need to transport large quantities of coins across dangerous territories. It simplified transactions in foreign currencies. It allowed merchants to conduct business in multiple cities without needing to physically move their entire wealth around. and it laid the groundwork for more sophisticated banking practices that would develop in medieval and modern times. However, letters of credit required trust. The system only worked if the merchant believed that he could actually collect his money at the distant location. This trust was built on reputation. Certain merchant houses, certain temples, and certain trading guilds became known as reliable issuers of letters of credit. Merchants would seek out these established institutions when they needed such services. The Sogdian merchants, an Iranian people who dominated much of the Silk Road trade during its peak centuries, were particularly skilled at using letters of credit. The Sogdians established trading colonies throughout Central Asia and into China. These colonies were connected by family ties and ethnic solidarity. When a Sogdian merchant in Samarkand issued a letter of credit payable at a Sogdian trading post in Chang'an, the merchant could be confident that his Sogdian colleagues would honor the commitment. The ethnic network provided the trust necessary for the system to function. Buddhist monasteries also played a role in this financial system. Monasteries along the Silk Road often had resources. Donations from pilgrims, income from attached farms or businesses. Some monasteries accepted deposits and issued payment instructions, essentially functioning as proto-banks. Merchants appreciated this service because monasteries had a reputation for honesty and because they were permanent institutions unlikely to vanish overnight like some merchants might. There were naturally problems with this system. Forgery was always a risk. If someone could convincingly copy the seals and signatures on a letter of credit, they could fraudulently collect money. This led to increasingly sophisticated anti-forgery measures. Some agents developed personal codes that would be split between two copies of a document, like two halves of a broken seal that had to match. Others used invisible inks or complex patterns that were difficult to reproduce. There was also the problem of time. A merchant receiving a letter of credit had to trust that the issuing institution would still exist when he arrived to collect payment. Along the unstable frontiers of great empires, cities could be sacked, merchant houses could collapse, temples could be destroyed. A letter of credit from an institution that no longer existed was worthless. Despite these challenges, letters of credit became increasingly common along the Silk Road. They represented a crucial step in the evolution of money. The recognition that currency did not need to be physically present. Value could be represented symbolically, transferred through writing and trust, rather than through the movement of metal and goods. We should pause here to discuss something that might not seem directly related to money, but was actually crucial to how merchants paid each other along the Silk Road. We are referring to the system of credit and debt. Merchants did not always pay for goods immediately. Often, transactions involve credit arrangements where payment would be deferred until a later date, sometimes until goods had been resold at the next market. This practice allowed trade to flourish even when individual merchants lacked sufficient liquid capital to purchase large quantities of goods up front. Credit relationships along the Silk Road were deeply personal. They depended on reputation, family connections, and long-standing relationships between trading partners. A merchant who honored his debts could build a network of creditors willing to extend him trade credit. A merchant who defaulted on debts would find himself unable to conduct business. The Buddhist and Confucian moral frameworks that influenced many Silk Road Merchants placed great emphasis on keeping one's word. Contracts were often verbal, sealed with a handshake or a shared meal rather than written documents. The social cost of breaking such a contract was high. A merchant who failed to pay his debts would be shunned by his community. His family might be affected. His descendants might struggle to establish their own trading relationships. This does not mean the system always worked. Defaults occurred. Merchants died before repaying debts. Wars disrupted trade routes and made it impossible for merchants to complete their obligations. Natural disasters could wipe out a merchant's inventory or capital. The ancient world lacked the complex bankruptcy and debt collection systems of the modern era. When debts could not be repaid, the consequences varied. In some cases, a merchant's family might be expected to assume the debt. In other cases, the creditor simply had to accept the loss. Some societies allowed for debt bondage, where a debtor or his family members would work for the creditor until the debt was satisfied, though this was less common in the cosmopolitan trading cities of the Silk Road than in more traditional agricultural societies. Interest rates on trade credit varied widely. Religious strictures complicated matters. Buddhism generally frowned upon usury. Islam, which would later become a major force along the Silk Road, forbade charging interest on loans to fellow Muslims. Some merchants found creative ways around these prohibitions. They might structure a transaction as a partnership rather than a loan, with the creditor entitled to a share of profits. They might charge fees for services rendered rather than explicit interest. They might build the cost of credit into the price of goods. The practical effect of credit was to multiply the effective money supply along the Silk Road. A merchant with 100 gold coins could, through credit arrangements, conduct business as if he had several times that amount. This allowed trade to expand beyond what would have been possible if every transaction required immediate payment in physical currency. Record keeping was essential to this system. Merchants maintained detailed accounts of credit extended and debts owed. These records might be kept on bamboo strips, silk paper, parchment, or clay tablets depending on the region and time period. The merchant who kept good records had an advantage. He could track his obligations and assets. He could demonstrate to potential creditors that he had a history of repaying debts. He could prove the details of a transaction if a dispute arose. Some of these ancient accounting records have survived, and they provide fascinating glimpses into the business practices of the time. We have accounts from the oasis cities of the Tarim Basin showing merchants tracking purchases and sales, debts and credits in meticulous detail. The level of mathematical sophistication is impressive. These merchants understood concepts like compound returns, risk assessment, and portfolio diversification. Having discussed the various forms of payment and credit, we should consider the practical act of paying for goods along the Silk Road. What did it actually look like when a transaction occurred? Let us imagine a specific scenario. A Roman merchant, having traveled for many months, has arrived in the city of Palmyra, a major trading hub in what is now Syria. He wishes to purchase a large quantity of silk that has been brought from China by a Sogdian merchant. The silk is of high quality. The threads are fine and even. The weave is tight. The colors are vivid. Both merchants know that this silk will fetch excellent prices in Rome. They meet in the courtyard of a caravanserai as the afternoon sun casts long shadows. Around them, other merchants conduct business. Camels are being loaded and unloaded. Servants bring tea. The atmosphere is busy, but not frantic. There is time for proper negotiation. The two merchants sit on cushions, arranged around a low table. An interpreter is present, for although both merchants know some common languages of trade, they want to ensure clear communication for such an important transaction. The Sogdian merchant's servant brings forth several bolts of silk and unwraps them for inspection. The Roman merchant examines the silk carefully. He holds it up to the light to check its transparency. Fine silk should let light pass through in a certain way. He rubs it between his fingers to feel the texture. He drapes it over his arm to see how it falls. He is checking not only the quality of this particular silk, but also comparing it to silk he has purchased before. He needs to know that he can sell this silk at a profit when he returns to Rome. After examining several bolts, the Roman merchant indicates which ones he wishes to purchase. Now comes the negotiation over price. The Sogdian merchant names a figure. The Roman merchant counters with a lower offer. They go back and forth, each explaining why their price is fair. The Sogdian mentions the rarity of this particular silk, the difficulty of transporting it across mountains and deserts, the demand from other buyers. The Roman points out market conditions in the western cities, the costs he has already incurred in his journey, the risks he will face in transporting the silk onward. This negotiation might last an hour, punctuated by cups of tea and polite conversation about other matters, news from their respective homelands, the condition of the roads, mutual acquaintances in the merchant community. Eventually, they agree on a price. Now comes the question of payment. The Roman merchant does not have enough gold coins to pay the full amount immediately. This is normal and expected. He proposes a mixed payment. He will pay part of the price in gold coins, which he produces from a leather pouch. The Sogdian merchant servant counts these coins and weighs them on a small portable scale to verify their value. For the remainder of the payment, the Roman merchant offers a combination of goods and a promise of future payment. He has brought wine from the Mediterranean, which is exotic and valuable in Central Asian markets. He offers several amphoras of wine as partial payment. The Sogdian merchant samples the wine and agrees to accept it at a certain value toward the total price. For the final portion, they agree on a credit arrangement. The Roman merchant will owe the Sogdian a specified sum, to be paid when the Roman returns from his next journey to Rome. In the merchant community of Palmyra, both men are known and trusted. The Sogdian is confident that the Roman will honor this debt, both because of the Roman's reputation and because the Roman will want to conduct business again in the future. Defaulting on this debt would destroy the Romans' reputation and make future trading difficult. To formalize the credit arrangement, they create a simple contract. A scribe is summoned, a literate person who can write in both Greek and Sogdian. The contract is written on parchment in both languages. It specifies the amount owed, the date by which payment is expected, and what will happen if payment is not made. Both merchants sign or seal the document. A copy is made for each merchant's records. A third copy might be deposited with a trusted third party, perhaps a temple or a merchant guild, to serve as an impartial record. The actual transfer of the silk takes time. The bolts must be counted and marked. The Roman merchants' servants take possession of the silk and transport it to their lodgings for safekeeping. The gold coins and wine are similarly transferred to the Sogdians' quarters. By the time everything is settled, the sun has set. The transaction that began in the afternoon has extended into the evening. This detailed process might seem inefficient by modern standards, where electronic payment can transfer enormous sums in seconds. But for these ancient merchants, the slow, careful, personal nature of the transaction was not a bug, but a feature. It allowed both parties to assess each other's trustworthiness. It provided time for them to verify the quality of goods and the authenticity of currency. It reinforced social bonds that made future transactions easier. In a world without banks, or legal systems that could span multiple empires, personal relationships were the infrastructure of commerce. We should discuss some specific problems that arose with payments along the Silk Road and how merchants attempted to solve them. The first problem was counterfeiting. As we have mentioned, merchants had to be constantly vigilant against fake coins, debased metals, and forged documents. The techniques for counterfeiting were sometimes quite sophisticated. We know from archaeological evidence that ancient counterfeiters would take genuine coins and carefully shave or file precious metal from the edges, then use that metal to create new coins with lower precious metal content. Some counterfeiters created coins that looked perfect, but were made of base metals coated with a thin layer of gold or silver. A cursory inspection might not reveal the fraud. Only when the coin was cut open or subjected to chemical tests would the deception become apparent. Merchants learned various testing methods. They might cut a small notch in a coin to check the metal throughout, not just on the surface. They might use touchstones and acids to test purity. They might simply trust their experience. The weight, sound, and feel of a genuine coin become familiar to someone who handles hundreds of coins every day. Governments attempted to prevent counterfeiting through severe punishments. Chinese law prescribed death for counterfeiters. Roman law was similarly harsh. Despite these deterrents, counterfeiting remained profitable enough that people continued to attempt it. The second problem was the instability of currency values. Wars, harvests, discoveries of new mines, changes in government policy, all of these could affect the value of currencies. A merchant who left home with what he thought was sufficient capital might find that by the time he reached his destination, currency values had shifted and his money was worth less than expected. Exchange rate fluctuations could also cause problems. Imagine a merchant who borrowed money in one currency with the plan to repay it after converting profits from sales in another currency. If the exchange rate moved unfavorably in the interim, the merchant might find himself unable to repay the debt, despite having made profitable trades. Merchants attempted to hedge against these risks through various strategies. Some merchants diversified their holdings, keeping wealth in multiple forms. Some coins, some precious metals, some gemstones, some goods. This way, if one form of value declined, others might hold steady or even increase. Some merchants developed relationships with currency experts, people who tracked exchange rates and advised on when to exchange one currency for another. These early financial advisors played a role similar to modern foreign exchange traders, though operating on a much smaller scale and with much less sophisticated tools. The third problem was security. We have mentioned this before, but it bears repeating. Transporting valuable goods and currency across thousands of miles of territory, some of it controlled by hostile powers or frequented by bandits, was inherently dangerous. Merchants took numerous precautions. They traveled in caravans for safety in numbers. A caravan might include dozens or even hundreds of people. Merchants, servants, guards, camel drivers, and others. The armed guards were essential. While they could not guarantee complete safety, they deterred casual banditry and provided defense against raiders. Merchants also tried to conceal their wealth. Instead of traveling with obviously valuable goods, they might disguise silk as a common cloth or hide gold coins in ordinary-looking containers. They developed various strategies for distributing risk. A merchant might split his capital among several caravans traveling by different routes. If one caravan was lost to bandits or natural disaster, the others might still arrive safely. Some merchants purchased insurance of a sort. They might pay a fee to a powerful local leader or a merchant guild for protection along a particular stretch of road. This protection money was essentially an early form of insurance premium. If the merchant was attacked despite paying this fee, the protector was obligated to compensate him for his losses or pursue the thieves. The concept of shared risk also emerged. A group of merchants might pool their capital for a joint venture. Each merchant would contribute funds and share proportionally in the profits or losses. This way, no single merchant bore the entire risk of a trading expedition. If a caravan was lost, each merchant lost only his share rather than his entire fortune. The role of governments and authorities in regulating payments and currency along the Silk Road was complex. Different empires had different approaches, and these approaches changed over time. The Chinese government, during various dynasties, maintained strict control over currency production. Only official government mints were legally allowed to produce coins. This was both a source of government revenue, the difference between the face value of a coin and the cost of the metal and production, and a way to maintain economic stability. By controlling the money supply, the government could influence prices and economic activity. However, enforcement was challenging. China was vast, and remote regions were difficult to monitor. Private mints did exist, sometimes openly defying imperial authority. In addition, during periods of political instability, when multiple regional governments competed for power, each might mint its own currency, leading to monetary confusion. The Chinese government also regulated trade with foreign peoples. At certain times and places, official trading posts were established where foreign merchants could exchange goods under government supervision. This allowed the government to collect taxes on trade and to control what goods entered and left China. These trading posts operated on the principle that the foreign merchants would present their goods. Chinese officials would assess the value, and payment would be made according to official rates. Foreign merchants often found these official arrangements frustrating. The official rates might be less favorable than what they could get in private transactions. The bureaucratic procedures could be slow. There were opportunities for corruption, with officials demanding bribes to process transactions. Nevertheless, during certain periods, official trade was the only legal option for foreign merchants wanting to do business in China. The Roman Empire had its own system of currency control. The Roman government minted coins at several locations throughout the empire. Roman coins bore the image of the emperor, serving both as a medium of exchange and as propaganda reinforcing imperial authority. The widespread acceptance of Roman coins throughout the Mediterranean world and beyond was a testament to Roman power and the stability of Roman currency. However, the Roman government periodically debased its currency, reducing the precious metal content of coins to stretch resources during times of financial pressure. This debasement was sometimes gradual and subtle, but over time it led to inflation and reduced confidence in the currency. Foreign merchants who had accepted Roman coins as payment might later discover that those coins were worth less than they had expected. Persian empires, including the Parthians and Sasanians, also minted standardized currency. Persian silver drachms were widely used in international trade. The Persian government maintained mints in major cities and attempted to ensure that its coinage met standards of weight and purity. Persian coins often featured elaborate designs showcasing royal power and religious symbolism. One interesting aspect of Persian currency was the continuity of design. Even as dynasties changed, new rulers often continued to use currency designs similar to those of their predecessors. This provided a sense of stability and familiarity that helped maintain the currency's acceptability in trade. Smaller kingdoms and city-states along the Silk Road also minted their own currencies. These local coinages were used primarily for local transactions, but they occasionally entered the broader circulation of Silk Road trade. The sheer variety of local currencies added to the complexity of conducting business across multiple jurisdictions. Taxation was another way governments influenced payment systems. Merchants passing through different territories had to pay tolls, tariffs, and other taxes. These payments were often required in local currency, forcing merchants to engage with local money changers and currency markets. The taxes collected by governments along the Silk Road were substantial and represented a major source of revenue for the states that controlled key routes. Some governments issued official exchange rates for foreign currencies. These rates might not reflect the actual market value of the currencies, but merchants had little choice but to accept them when dealing with government officials. Savvy merchants learned to adjust their prices to account for unfavorable official exchange rates. Religious institutions played a surprisingly important role in the payment systems of the Silk Road. Buddhist monasteries, Zoroastrian fire temples, Christian churches, and later Islamic mosques and caravanserais all participated in the economic life of the trade routes. Buddhist monasteries were particularly prominent in this regard. Buddhism spread along the Silk Road from India to Central Asia to China, carried by missionaries and merchants. As Buddhism spread, monasteries were established in cities and towns along the route. These monasteries needed to sustain themselves. They received donations from pilgrims and wealthy patrons. They sometimes owned agricultural land or operated businesses. Over time, many monasteries accumulated considerable wealth. This wealth made monasteries attractive to merchants seeking financial services. Monasteries could offer loans to merchants, accepting interest payments that were often structured as donations, rather than explicit interest, to avoid religious prohibitions on usury. Monasteries could accept deposits for safekeeping. A merchant traveling light might deposit surplus capital with a monastery, receiving a receipt that he could present on his return to reclaim his deposit. Some monasteries even issued a form of paper credit. A merchant depositing valuables at a monastery in one city might receive a document entitling him to collect equivalent value at a monastery in another city. This was similar to the letters of credit discussed earlier, but with the authority and trust of religious institutions backing the transaction. The motivation for monasteries to provide these services was partly religious. Supporting merchants and facilitating trade was seen as a form of merit, contributing to the spiritual development of the monks and the monastery. It was also practical. By participating in commercial activity, monasteries could generate income to support their religious functions. Zoroastrian fire temples in Persian territories played a somewhat similar role, though Zoroastrianism's relationship with commerce was different from Buddhism's. Zoroastrianism emphasized truth and honesty in all dealings, making Zoroastrian institutions trusted arbiters in business disputes. Fire temples sometimes served as places where contracts were signed and witnessed, with the religious authority of the institution ensuring that parties honored their commitments. After Islam spread into Central Asia and beyond, starting in the 7th century CE, Islamic institutions introduced new financial practices that influenced Silk Road commerce. Islamic law had detailed rules about commercial transactions. It prohibited riba, usually translated as usury or interest. But the interpretation of what constituted prohibited riba versus legitimate profit was complex and evolved over time. Islamic merchants developed various partnership and investment structures that complied with religious law while still allowing capital to be put to productive use. One common structure was the Mudaraba partnership, where one partner provided capital and another provided labor and expertise. Profits would be shared according to an agreed-upon ratio, while losses would be borne entirely by the capital provider. This allowed investors to fund trading expeditions without charging explicit interest. Islamic caravanserais, or Hans, became important commercial institutions. These were not merely inns where travelers could stay. They were comprehensive commercial facilities. A large caravanserai might include lodging, stables for animals, storage facilities, shops, money changers, scribes who could draft contracts, and sometimes even small mosques or prayer rooms. Some caravanserais were built and operated by charitable religious endowments called waqfs, which provided services to travelers as a form of pious donation. The presence of these religious institutions along the Silk Road created a network of trusted intermediaries that facilitated commerce. A merchant far from home, dealing with unfamiliar people in a foreign land, could turn to religious institutions for assistance, confident that shared religious values would provide some baseline of trustworthy behavior. It is worth noting that this religious participation in commerce was not without controversy. Some religious figures worried that involvement in trade and finance distracted from spiritual pursuits. There were debates within Buddhist, Zoroastrian, and Islamic communities about the proper relationship between religious institutions and commercial activity. These debates shaped how religious institutions engaged with merchants and money. Let us now consider the experience of specific merchant communities along the Silk Road and how they managed payments. The Sogdians, whom we have mentioned several times, were perhaps the most successful merchant community of the Silk Road's peak period. The Sogdians were an Iranian people who lived in the region of Central Asia, roughly corresponding to modern Uzbekistan and Tajikistan. Their cities, Samarkand, Bukhara, Penjikent, were major commercial centers. The Sogdians had several advantages that made them successful in Silk Road trade. They were multilingual, often speaking several of the languages used along the trade routes. They had extensive kinship networks. Sogdian merchant families would send members to establish trading posts in distant cities. These family connections created trust networks that facilitated credit and the use of letters of credit. Sogdian merchants were also known for their literacy and numeracy. They kept detailed accounts. They understood complex financial arrangements. Archaeological excavations of ancient Sogdian sites have uncovered numerous commercial documents written in Sogdian script on paper, leather, and wood. These documents include contracts, receipts, letters between merchants, and account books. They give us remarkable insights into Sogdian business practices. One interesting practice was the use of small clay seals, or bulle, to secure documents and packages. A merchant would tie a cord around a package or document, then attach a lump of clay over the knot. Before the clay dried, he would press his personal seal into it. This seal, unique to each merchant, served as a kind of signature. Anyone could verify that the package had not been opened by checking that the seal was intact. Letters of credit and contracts might be secured with multiple seals, those of the merchant, witnesses, and perhaps local authorities, providing layers of authentication. Another prominent merchant community was the Jewish merchants who operated along various Silk Road routes. Jewish trading networks extended from Europe through the Middle East to India and even to China. These merchants relied on religious and kinship ties to facilitate trust in business dealings. Jewish merchants used Hebrew and Judeo-Arabic scripts for business correspondence. Their networks were linked through synagogues in trading cities. A Jewish merchant traveling to a distant city could seek out the local Jewish community and through shared religious identity establish the connections needed to conduct business. The Cairo Geniza, a collection of hundreds of thousands of documents preserved in a synagogue storeroom in medieval Cairo, includes many commercial letters and contracts from Jewish merchants engaged in Indian Ocean and Silk Road trade. These documents reveal sophisticated use of credit, partnership arrangements, and bills of exchange similar to letters of credit. They show merchants making calculations about risk, profit margins, and optimal trade routes. Arab and Muslim merchants became increasingly prominent on the Silk Road after the Islamic conquests of the 7th and 8th centuries. Muslim merchants brought new commercial practices influenced by Islamic law and custom. They established trading colonies in Chinese cities, with significant Muslim communities in Chang'an and other major centers. Muslim merchants made extensive use of partnership contracts, particularly the mudaraba mentioned earlier. They also used hawala, an informal value transfer system that allowed money to be transferred across long distances without physically moving currency. In a hawala transaction, a merchant would give money to a hawala dealer in one city. The dealer would contact a corresponding dealer in another city, who would pay the equivalent amount to the merchant's recipient. The two dealers would settle accounts later often by offsetting transfers going in opposite directions. This system relied entirely on trust and reputation within the Hawala network. Chinese merchants also engaged in Silk Road trade, though they were generally less prominent on the western portions of the route. Chinese merchants from the western regions of the empire, such as Gansu and Xinjiang, were more likely to participate in international trade than merchants from the Chinese heartland. These Chinese traders brought goods westward, silk, obviously, but also tea, ceramics, jade, and other products, and returned with horses, woolens, glassware, and precious stones. Chinese merchants had to navigate a complex relationship with their own government. As mentioned earlier, the Chinese government sometimes restricted private foreign trade. There were periods when Chinese merchants could legally trade with foreigners only through official channels. At other times, private trade was permitted, or at least tacitly tolerated. Chinese merchants operating in Central Asian markets sometimes had to carefully balance their desire for profit with the risk of running afoul of government regulations. We should not neglect the role of small-scale merchants and peddlers, who also participated in Silk Road trade, operating on a much more modest scale than the great merchant houses we have been discussing. These small traders might never travel the full length of the Silk Road. Instead, they would operate within a particular region, buying goods from caravans arriving from distant places and selling them in local markets. Or they might specialize in one particular commodity, becoming experts in its quality and value. For these small merchants, the payment systems we have discussed could seem overwhelming. They lacked the capital to extend credit on large transactions. They could not afford to wait months or years for a letter of credit to be honored. They needed simpler, more immediate forms of payment. Small-scale merchants often relied on basic barter or small denominations of currency. A peddler selling spices in a local market might accept payment in bronze coins of minimal value or in small quantities of other goods. The transactions were immediate and simple. The buyer inspected the goods, agreed on a price, handed over payment, and took possession of the purchased items. These small merchants faced their own challenges. They had to be even more vigilant about counterfeit coins because they lacked the resources to absorb losses from fraud. They had to be astute judges of quality because their profit margins were smaller. They operated in a world where a few bad transactions could mean the difference between modest prosperity and destitution. Yet these small merchants were crucial to the overall functioning of Silk Road trade. They were the ones who distributed imported goods to ordinary consumers. The silk that had traveled thousands of miles from China, passing through the hands of multiple large-scale merchants, might ultimately be sold to a local aristocrat by a small market trader who had purchased a few bolts from a caravan and was retailing them in smaller quantities. Women also participated in Silk Road commerce, though historical records are less clear about their activities. In some societies, women could own property and conduct business independently. In others, they operated through male relatives, but still exercised significant economic influence. Women might manage market stalls, sell textiles and household goods, or operate small-scale money-changing services. Archaeological evidence suggests that some female merchants accumulated considerable wealth. tombs excavated along the Silk Road have yielded female burials with rich grave goods, including gold coins, jewelry, and luxury items that suggest the deceased had been prosperous. Some of these women may have been the wives or widows of merchants, but others may have been merchants in their own right. Let us consider what happened when the payment systems we have discussed failed. Disputes were inevitable in any trading system, and the Silk Road was no exception. A merchant might claim that coins he received were counterfeit. The seller might insist they were genuine. Who was right? How could the dispute be resolved? In the absence of a unified legal system spanning the Silk Road, merchants relied on various dispute resolution mechanisms. Local courts and legal systems could adjudicate disputes, but their effectiveness varied. In Chinese territory, disputes might be brought before local magistrates who would hear evidence and render judgment. The sophistication of Chinese legal codes meant that there were established procedures for commercial disputes. However, foreign merchants might find these courts intimidating and the outcomes unpredictable. In Persian territories, local courts following Zoroastrian or later Islamic legal traditions would handle disputes. Islamic law in particular had detailed provisions for commercial disputes. Qadis, Islamic judges, were trained in commercial law and could render judgments on matters like contract enforcement, debt collection, and fraud. However, for disputes between merchants from different cultural and legal traditions, local courts were not always satisfactory. A Chinese merchant and a Roman merchant, neither comfortable with Persian law, might be reluctant to submit their dispute to a Persian qadi, fearing unfair treatment or misunderstanding of the issues. This led to alternative dispute resolution mechanisms. Merchant guilds played an important role. A merchant guild was an association of traders who shared common interests. Guild members agreed to abide by the guild's rules and to submit disputes to arbitration by guild leaders. The guild's judgment might not have legal force, but it carried social weight. A merchant who defied a guild judgment might be expelled from the guild, losing access to its network and support. In practice, merchant guilds enforced their judgments through reputation. A merchant found guilty of fraud by a guild arbitration would be boycotted by other guild members. Word of the dispute and its resolution would spread through the merchant community. The guilty merchant might find it difficult to conduct future business anywhere along the trade routes. Some disputes were resolved through mediation rather than adjudication. Respected elders, religious figures, or successful merchants might be asked to mediate between disputing parties. The mediator would listen to both sides, ask questions, consult with experts if needed, and then propose a solution. While the mediator's solution was not binding, both parties usually accepted it because they had agreed to the mediation process, and because rejecting the mediator's solution would damage their reputation. In some cases, disputes were resolved through oaths. A merchant accused of fraud might swear a sacred oath that he was innocent. In many cultures, the fear of divine punishment for a false oath was sufficient to ensure honesty. If a merchant was willing to swear such an oath, the accuser might accept his word and drop the dispute. There were also cases where disputes were never formally resolved. The parties might simply avoid each other in the future, each considering the other dishonest. They would warn their friends and associates about each other. and the network of merchant relationships would root around the dispute. The threat of violence was always present, but was generally a last resort. Merchants who attacked each other or their property would face severe consequences from authorities and from the merchant community. The Silk Road trade depended on a certain level of social order. Too much violence would make trade impossible. Nevertheless, there were instances of merchants hiring thugs to recover disputed property or to punish those who had wronged them. Theft and robbery presented different challenges. When a merchant's goods or money was stolen, whether by professional thieves, bandits, or dishonest trading partners, recovery was difficult. The merchant might report the theft to local authorities, but in practice, the chances of recovering stolen goods were slim. If the theft occurred in the wilderness rather than in a city, there might be no authorities to report to. This is why merchants took such elaborate precautions to prevent theft in the first place. They traveled in groups, hired guards, concealed valuable goods, and used financial instruments, like letters of credit, to avoid carrying large amounts of physical currency. Insurance, in the modern sense, did not exist along the Silk Road. There were no insurance companies that would reimburse merchants for losses. However, some of the practices we have discussed, shared risk partnerships, splitting capital among multiple caravans, protective agreements with local powers, served similar functions to insurance by spreading risk among multiple parties. As centuries passed, the payment systems along the Silk Road evolved. New technologies, new institutions, and new ideas transformed how merchants paid each other. The invention and spread of paper money was particularly significant. As we mentioned earlier, paper money first appeared in China. During the Song dynasty, merchants in Sichuan province began using certificates of deposit issued by banks. These certificates could be transferred from one person to another, serving as a medium of exchange. The government eventually took over the issuance of paper money, recognizing its potential as a tool of economic policy. Paper money had obvious advantages over coin currency. It was much lighter and easier to transport. Large sums could be carried in a single pouch, rather than requiring carts loaded with heavy bronze coins. However, paper money also presented challenges. It had no intrinsic value. Its value depended entirely on the government's promise to redeem it for goods or services, and on people's confidence in that promise. When governments issued too much paper money, inflation resulted. The Song, Jin, and Yuan dynasties all experienced periods of severe inflation when excessive issuance of paper money led to loss of confidence in the currency. Marco Polo, the famous Venetian merchant who traveled to China in the late 13th century, wrote with amazement about paper money. To Europeans of his time, the concept seemed almost magical, that a piece of printed paper could have value equivalent to gold or silver. Yet Marco Polo observed that in China, paper money functioned effectively. People accepted it in transactions. Merchants used it to conduct business. The government backed it up with the threat of severe punishment for anyone who refused to accept it. The Mongol Empire, which controlled much of the Silk Road during the 13th and 14th centuries, attempted to standardize commercial practices across its vast territory. The Mongols established a postal relay system that could also be used to transmit financial documents. They provided security along trade routes, reducing the risk of banditry. They attempted to standardize weights, measures, and sometimes even currency across different regions. Under Mongol rule, Silk Road trade reached its peak. The relative safety of the routes and the political unity of much of Eurasia under Mongol control meant that merchants could travel with greater confidence than in previous centuries. The payment systems we have discussed, coins, barter, letters of credit, credit arrangements, all flourished during this period. The Mongols themselves used a currency system that combined traditional coins with paper money. The paper money issued by the Mongol Yuan dynasty in China was denominated in strings of coins, maintaining a connection to traditional currency, even as it offered the convenience of paper. The back of yuan paper money was often stamped with multiple official seals, making counterfeiting difficult. However, the Mongol period also revealed the limits of attempts to standardize payment systems across vast distances. Different regions of the Mongol Empire continued to use their own currencies and payment methods. Merchants still had to navigate multiple monetary systems. The dream of a single unified currency stretching from China to Europe remained elusive. We should also consider how seasonal patterns and cycles affected payment along the Silk Road. Trade was not constant throughout the year. It followed rhythms determined by geography, climate, and culture. The most obvious rhythm was seasonal. Travel through mountain passes was impossible during winter when snow blocked the routes. The oases of Central Asia were more pleasant in spring and autumn than in the scorching summer or bitter winter. The monsoon seasons affected maritime routes that connected to the Silk Road trade network. This seasonal pattern affected payment. Merchants might need to borrow money in spring to finance a trading expedition, with repayment due in autumn when they returned with profits from sales. Credit arrangements had to account for these seasonal rhythms. A merchant who promised to repay a debt after the harvest was making a specific reference to a future time that both parties understood. Agricultural cycles also affected currency and payment. After harvest, when farmers sold their crops, more currency would circulate in rural areas. Prices for goods might drop as people had more money to spend, and merchants competed for customers. Before harvest, when food stores were running low and farmers had not yet sold the new crop, currency might be scarce and prices higher. Merchants who understood these cycles could profit from them. Buying goods in one season and selling them in another, when prices were more favorable, was a basic trading strategy. Credit terms might be negotiated differently, depending on the time of year. Interest rates might vary with the agricultural cycle. Festival and religious cycles also mattered. Major religious festivals or celebrations might draw crowds of people to particular cities, creating temporarily high demand for certain goods and affecting prices. A merchant who timed his arrival to coincide with a major festival might find eager buyers willing to pay premium prices for luxury goods. Tax collection cycles affected commerce as well. Governments typically collected taxes at particular times of the year, often after harvest. In the weeks following tax collection, there might be less currency in circulation as farmers and merchants had just paid a portion of their wealth to the government. This could affect trade volumes and credit availability. Long-term cycles also influence Silk Road trade and payment systems. Wars and periods of political instability would disrupt trade routes, making some paths dangerous or impossible. During peaceful periods, trade would flourish. The opening or closing of particular routes could dramatically affect which cities prospered and which declined. Climate cycles such as periods of drought or unusually cold weather could affect agricultural production and thus the availability of food and other goods for trade. A famine in one region might create opportunities for merchants who could bring in food from elsewhere, but it would also disrupt normal trading patterns. These various cycles meant that merchants had to be flexible. A successful merchant could not rely on a single strategy or a fixed set of trading partners. He had to adapt to changing conditions, recognizing when to extend credit, when to demand immediate payment, when to accept goods instead of currency, and when to hold assets in one form rather than another. Let us pause to consider the actual experience of a merchant dealing with payment issues on a specific journey. This will help us understand how all the systems we have discussed function together in practice. Our merchant is a Sogdian from Samarkand named Vahram. He is in his 30s, an experienced trader who has made several journeys along various Silk Road routes. This year, he has decided to lead a caravan to China to purchase silk and other goods for resale in Central Asia, and perhaps as far west as Persia. Vahram's preparation begins months before his departure. He needs to accumulate capital for the journey. Some of this capital is his own savings from previous trading ventures. But Vahram needs more than his personal resources. He seeks partners and investors. Vahram arranges a Mudaraba partnership with several wealthy individuals in Samarkand. These investors provide capital, and Vahram provides his expertise and labor in managing the caravan. They agree that Vahram will receive 30% of the profits as compensation for his work, while the investors will share the remaining 70% proportionally to their contributions. If the venture fails and money is lost, the investors bear the loss, while Vahram loses only his time and effort. With capital assembled, Vahram purchases goods to trade. He buys fine glassware, which is produced in Central Asia and unknown in China. He purchases indigo dye and saffron. He buys silver, both bars and coins, knowing that silver is valued in China. These goods are packed carefully onto camels. Vahram also converts some capital into portable forms. He purchases several letters of credit from established merchant houses in Samarkand. These letters will allow him to access additional funds in Chinese cities without carrying all his capital with him. He sews gold coins into hidden pockets in his clothing as an emergency reserve. He carries a modest amount of various currencies: Sogdian silver coins, Persian drachms, some Chinese bronze coins from a previous journey, to pay for supplies along the route. The journey begins in spring, after the mountain passes have cleared of snow, but before the summer heat becomes unbearable. Vahram's caravan includes 30 camels carrying goods, plus additional animals for riding. He has hired guards, camel drivers, and servants. In all, the caravan numbers about 40 people. As the caravan travels east, Vahram makes numerous small transactions. At each oasis town, he must pay for water, food, and lodging for his people and animals. These payments are usually in the local currency, which means Vahram must visit money changers to exchange whatever currency he has for the local coins. Each exchange costs him a small commission and exposes him to the risk of unfavorable exchange rates or counterfeit coins. At some stops, Vahram sells small quantities of his goods. A glass vessel here, a bit of saffron there. These sales provide him with local currency and also help him gauge market conditions. If glass is selling well in this oasis town, it might sell even better further east. If the price offered is disappointing, Vahram knows to hold his goods for a better market. The caravan faces difficulties. At one point, robbers attack. Vahram's guards drive them off, but not before several camels are lost. The goods those camels carried, and the camels themselves, represent a significant loss. Vahram records this loss carefully. His investors will need to account for it when calculating profits. When Vahram reaches the Chinese frontier, he must deal with Chinese authorities. The border crossing involves tariffs. Chinese officials inspect the goods and assess their value. Vahram must pay the required taxes in Chinese bronze coins. He has anticipated this and brought Chinese currency from Samarkand, but the exchange rate the officials use is less favorable than the market rate. Vahram accepts this as a cost of doing business. In Chinese cities, Vahram sells most of his goods. He uses the proceeds to purchase silk, jade, and porcelain. These transactions involve lengthy negotiations with Chinese merchants. Vahram must rely on interpreters, as his command of Chinese is limited. Payment is in Chinese bronze coins, in bars of silver that Vahram has brought, and in some cases, in letters of credit that Vahram presents to Chinese merchant houses that have relationships with his Sogdian partners back home. One significant transaction involves purchasing a large quantity of high-quality silk. The Chinese merchant agrees to sell but wants partial payment in Roman gold coins, which are prized in China for their gold content and exotic origin. Vahram does not have Roman coins, but he knows other merchants in the caravan who do. He negotiates a three-way exchange. Vahram trades some of his silver to a merchant who has Roman gold. That merchant pays part of Vahram's purchase price. Vahram pays the remainder in Chinese bronze and a promissory note to be paid when Vahram returns to Samarkand with his profits. The return journey takes months. By the time Vahram arrives back in Samarkand, nearly a year has passed since he departed. He immediately sets about selling the Chinese goods he has brought back. The silk sells for more than triple what he paid in China. The jade and porcelain also fetch good prices. Vahram settles accounts with his partners and investors. He calculates total revenue from sales, subtracts the costs of the journey. Goods purchased, supplies, wages for guards and servants, payments to authorities, losses to robbery, and determines the profit. His investors are satisfied with their returns, and Vahram himself has earned enough to begin planning his next journey. Throughout this entire enterprise, Vahram had to constantly manage different forms of money and payment. He dealt with coins from multiple empires. He used letters of credit. He extended credit and received credit from trading partners. He paid taxes and tolls. He exchanged currencies dozens of times, each time losing a bit to commissions and exchange rate spreads. He assessed the purity of precious metals. He navigated commercial law in multiple jurisdictions. He relied on his reputation and that of his family and trading partners to build the trust necessary for large transactions. Vahram's experience was typical of merchants along the Silk Road. The details varied. Different goods, different routes, different challenges. But the fundamental reality was the same. Success required understanding the complex systems of payment and exchange that made long-distance trade possible. As we near the end of our journey through the history of money along the Silk Road, we should reflect on the legacy of these ancient payment systems. The Silk Road trade reached its peak in the 13th century under the Mongol Empire. In the following centuries, the importance of the overland Silk Road routes gradually declined. Several factors contributed to this decline. The Black Death, the devastating plague pandemic of the 14th century, spread along trade routes and killed millions of people across Eurasia. The disease disrupted trade as cities were quarantined and merchants feared travel. The psychological impact was profound. People associated distant trade with the introduction of disease. Political fragmentation also played a role. After the Mongol Empire collapsed, the unified political control that had facilitated trade disappeared. Instead, merchants faced a patchwork of kingdoms, emirates, and khanates, each with its own laws, tariffs, and currencies. This made overland trade more difficult and expensive. Most importantly, maritime trade routes became more important. European nations developed improved ships and navigation techniques. The Portuguese, in particular, established a maritime route to Asia around the southern tip of Africa. These sea routes allowed goods to be transported more quickly and safely than overland caravans could manage. By the 16th century, the ancient Silk Road routes had become secondary to maritime commerce. However, the legacy of the Silk Road payment systems persisted. The techniques and institutions that merchants developed to handle money along the Silk Road influenced later financial systems. The concept of bills of exchange, which became crucial to European banking in the medieval and early modern periods, had roots in the letters of credit used by Silk Road merchants. The idea of partnership arrangements that complied with religious restrictions on usury influenced the development of Islamic banking and finance. The practice of using trusted intermediaries to transfer value across distance evolved into modern correspondent banking relationships. The importance of reputation and social networks in facilitating commerce is still relevant in global business today. Some physical remnants of the ancient payment system survive. Museums around the world hold collections of coins from Silk Road civilizations. These coins tell stories. The image of an emperor or king on a coin speaks to political authority. The inscription in multiple languages shows cultural exchange. The finding of coins far from where they were minted demonstrates the reach of ancient trade networks. The varying quality and weight of coins reveals periods of inflation, debasement, and economic crisis. Archaeological excavations of ancient Silk Road cities have uncovered commercial documents, contracts, account books, and other records that give us intimate glimpses into how merchants actually conducted business. The Sogdian documents from the ruins of Penjikent, the Judeo-Arabic letters from the Cairo Geniza, the Chinese account books from Dunhuang all contribute to our understanding. The cities that flourished along the Silk Road remain today, though transformed by time. Samarkand, Bukhara, Xi'an, Kashgar, Merv, Palmyra. These places were once great commercial centers where merchants from around the known world met to trade. Walking through these cities today, standing in the ruins of ancient caravanserais, one can almost imagine the bustling markets of centuries past. the negotiations over silk and spices, the clinking of coins, the careful weighing of precious metals, the sealing of contracts that bound merchants across vast distances. We began this journey by imagining a merchant in his caravanserai, contemplating his chest of various currencies. We have traveled with him in spirit, along thousands of miles of trade routes. We have explored the many ways merchants paid each other, through barter, coins, precious metals, letters of credit, credit arrangements, and personal trust. We have seen how governments, religious institutions, and merchant communities all shaped the systems of payment. The story of money along the Silk Road is not a simple story of progress from primitive barter to sophisticated currency. Rather, it is a story of adaptation and complexity. Different situations called for different forms of payment. A small purchase in a local market might use simple barter or low-value coins. A major transaction between merchants from different empires might involve a complex mixture of immediate payment, credit, and multiple forms of currency. Merchants were pragmatic. They used whatever payment methods worked in a given situation. They developed innovations to solve practical problems. When carrying large amounts of coin was dangerous, they invented letters of credit. When religious law prohibited interest, they created partnership structures that achieved similar economic results while respecting religious obligations. When currency was unstable, they diversified their holdings across multiple forms of value. The payment systems of the Silk Road reveal something profound about human society. Long before modern banks, stock markets, and digital currency, people found ways to conduct complex economic transactions across vast distances and cultural divides. They built systems based on trust, enforced through reputation and social networks. They created institutions that lasted for centuries. They developed mathematical and record-keeping sophistication that allowed them to track intricate webs of debt and credit. These ancient merchants will probably not be entirely confused by our modern financial system. The specific technologies have changed dramatically. Paper currency, electronic transfers, credit cards, cryptocurrencies are all innovations they never imagined. But the fundamental challenges will be familiar. How do you establish trust with someone you have never met before? How do you prove the value of what you offer? How do you protect yourself from fraud? How do you manage risk in uncertain markets? These are timeless questions. As we drift towards sleep, we can reflect on the countless individual transactions that made up the grand phenomenon we call the Silk Road. Each purchase of silk, each exchange of currency, each extension of credit represented a moment of human connection. A Chinese artisan wove silk that would eventually adorn a Roman senator. A Persian merchant's silver paid a Chinese farmer. A Sogdian trader's letter of credit connected Samarkand to Chang'an. These connections, repeated countless times over many centuries, wove together cultures that might otherwise have remained isolated. The techniques for paying each other were not merely economic necessities. They were threads in a vast cultural tapestry that spanned Eurasia. Ideas traveled along the same routes as goods and money. Buddhism spread from India to China. Paper and gunpowder spread from China to the West. Mathematical knowledge, astronomical observations, medical practices, musical instruments, artistic styles, all flow along networks established primarily for trade. The payment systems that facilitated this trade were therefore facilitating something much larger. They were part of the infrastructure of cultural exchange that made the Silk Road significant in world history. When we study ancient coins, we are not just studying economics. We are studying the tools that help different human societies learn from each other. And so, we conclude our quiet exploration of money along the ancient Silk Road. We have moved slowly through oasis cities and across mountain passes. We have sat with merchants as they negotiated prices and examined coins. We have contemplated the weight of precious metals and the trust represented by a sealed document. We have watched caravans load and unload, money change hands, and contracts be signed. The ancient trade routes are mostly silent now. Modern highways and railways follow different paths. Jet aircraft carry more goods in hours than caravans could transport in months. Digital payments transfer value at the speed of light. The bronze coins and silver drachms lie in museums or buried in ruins. Yet something of that ancient world persists. When we conduct international business today, we are the distant heirs of those Silk Road merchants. When we exchange currencies, trust financial institutions, extend credit, or rely on contracts, we are using refined versions of techniques they pioneered. The practical wisdom they accumulated, the importance of reputation, the need for intermediaries, the value of diversification, the challenge of assessing risk remains relevant. And perhaps as sleep approaches, we can appreciate the human ingenuity and determination represented by these ancient payment systems. In a world without electronic communication, reliable maps, strong legal systems, or standardized currency, people found ways to conduct commerce across staggering distances. They solved problems, they built trust, they created wealth and connections. The merchant in the caravanserai, sorting through his chest of varied currencies, was participating in one of humanity's great collaborative achievements, the peaceful exchange of goods and ideas across the known world. His careful counting of coins, his assessment of silver purity, his review of letters of credit, were all part of a grand enterprise that enriched civilizations and connected cultures. As we rest, we carry with us an appreciation for the complexity and humanity in these ancient economic systems. The Silk Road was never just about silk, and money was never just about coins. Both were means by which human beings reached across distance and difference to connect with each other, to trade not just goods, but culture, knowledge, and understanding. In that sense, the lessons of the Silk Road payment systems remain timeless, even as we drift into peaceful sleep.